Hey there, Kenneth French of Vast Voice, telling business secrets to entrepreneurs. We're very, very happy you stopped by. Either you're going to watch this or listen to this because you want to take your business to the next level. You're probably an entrepreneur who's either just starting out or you've been around for quite a while and you want to take your business to the next level. You're probably a real estate investor, maybe even a real estate agent, maybe a professional or of some sort, professional advisor of some sort. And well, you are stopping by because you need some valuable advice from one of the top industry leaders there is. Anyway, thank you very much. Once again, Kenneth French, Vast Voice, telling business secrets to entrepreneurs. Really glad you stopped by. Your financial advisor is wrong. Yes, you can invest qualified plans, 401ks, profit sharing plans, defined benefit plan assets in alternative assets to include real estate, private offerings, crypto. The list goes on. Hey there, Kenneth French with vastsolutionsgroup.com. As a matter of fact, we were one of the first groups to allow crypto and defined benefit plans years ago. So we've been around for a while. Company's been around since 1969. I took over in 2006. We're going to get right to it. This is going to add some value to you, the business owner who probably has a 401k or profit sharing plan, and you want to invest in assets that are, well, not traditional, meaning outside the realm of stocks, bonds, mutual funds, et cetera. So we're going to get right to it. I'm going to show you my screen, and then this is going to add some value to you because you're going to now understand kind of the specifics of, well, investing in qualified plans. You're in qualified plan assets in alternative assets. So let's go into it right now. We calling this investing in alternative assets within retirement plans. vastsolutionsgroup.com. Once again, my name is Kenneth French. Written a number of books, been helping small business owners invest in retirement plan assets as an example to help lower tax liability legally, ethically, and morally. Let's get right to what really the topic of the day is, and that's retirement plans that are able to invest in assets that are alternatives. So yes, the plans I mentioned before, 401k plans, profit sharing plans, defined benefit plans, cash balance plans. These are all assets that can be invested in, let's say, alternative assets. Again, real estate, private memorandums, or crypto. A lot of financial advisors will tell you can't. It's not because they're trying to lead you astray, et cetera, et cetera. For one, they don't know it in some cases, but also for compliance, don't know. Their own compliance arm can only look at so many investments versus all the investments out there, all the crypto that would be out there, or all the pieces of real estate that would be out there. So they can't. So they have to have a relatively small, very small, frankly, universe from which to choose. Well, we at vastsolutionsgroup.com believe in, giving the trustee, the client, really authorization to be able to invest in whatever they want. They care about their assets more than anyone, right? So it's really up to them. It's up to the client. In our case, trustees who are really in control of the 401ks, profit sharing plans, defined benefit plans, cash balance plans. It's up to them to make the determination what they're going to be investing in. So, let's say you have no employees and you want to invest your defined benefit plan assets in a piece of crypto. Well, yeah, you can do that. A piece of crypto, a piece of real estate, or in crypto, you can do that. There are some specifics that we're going to get into in just a little bit. Now, what's the process? Let's just say you have money in a defined benefit plan. You can direct those assets. Let's just say you have $1 million in your defined benefit plan. You want to, put whatever, $100,000 into a piece of real estate. You can do that. Generally speaking, you can do that. The plan assets, you'll write a check or wire, whatever the case is, to the place to the custodian that will hold the asset. Therefore, you're going to write a $100,000 check for that piece of real estate. Piece of real estate will be held in the name of the qualified plan, in my example, in the defined benefit plan. So you can either do a contribution or you could do move the assets via wire if they're already in there. If you could wire, do a check, et cetera, et cetera. Investing now, it's a little unique because not a lot of people do it. So it's unique because remember, we're open architecture. You can invest in nearly whatever you want. There are rules, by the way. And what I would say is call in the office or go to our website at vastsolutionsgroup.com. We do have some specifics for you. But what I would say is, do this with great care. And we're going to go into that in just a little bit. Asset ownership, kind of some of the specifics. These are the really big elements to think about. Plan assets held in the plan name. So when you make your investment, I'm going to remind you, when you make your investment, make it in the plan name. So let's just say it's ABC, or here we said XYZ defined benefit plan. The defined benefit plan's name will be what will go on the ownership at the investment. So let's say you're investing in a piece of land as an example. The title of the land will be, in this case, an XYZ defined benefit. Does that make sense? And sometimes, usually, the investment will want the paperwork to confirm the ownership. So in this case, you'll give the plan documents, as sometimes they're called in 401ks, profit share plans, defined benefit plans, etc. You'll give them plan documents for the XYZ defined benefit plan. Okay, does that make sense? So they'll probably say, could we see the plan documents? Just like they would say, if you're investing as an individual, we want to see your social security card as an example, or we want to see the paperwork that would outline you as an individual. Same thing for a qualified plan. In this case, 401k, defined benefit plan, et cetera. I mentioned this was a defined benefit plan. So you're going to show your defined benefit plan paperwork, which you should have as a trustee, by the way, or your administrator potentially would also have that in their possession and give that to you so you can send a copy. And usually, remember, by the way, you have to have it signed as the trustee. Investment is, here we say investment in ABC investment. Any investment made by the plan has to be signed as such. Usually it's John Doe, your name, comma, TTEE, which means trustee. So your name, if you're the trustee, if you're the one who's in control of the plan assets, your name, comma, TTEE. So when you sign for the documents that show that the plan is going to own the asset, if you will, write your name, comma, TTEE. Let's go over really quickly the benefits of our alternative investments, because I believe there are some in the right circumstance. By the way, we're going to go with the caveats later on. You get to diversify. Let's say you're heavily invested in the stock market, or maybe in some annuities or life insurance, or whatever the case is. You are further diversified. Instead of being in, let's say, traditional assets, now you're far afield, so it'll take you. It gives you, all your eggs aren't in just one basket, as an example. Higher returns. Sometimes alternative investments like real estate, like crypto, as an example, will give you a higher rate of return, which is awesome. Protection against market volatility. You can lower your risk curve because you're investing in something that might kind of help. Really, it's diversification, but really make sure that on the continuum of risk, you're closer towards more conservative, depending on the circumstances. Inflation hedging, especially if it's real estate, I would say, or gold, as an example. I could say that it potentially, it being alternative investments, would basically hedge inflation. It makes it so you don't have so much inflation potentially to worry about. Attractive risk-adjusted returns. That's too technical for this, but the reason I put that on there is because sometimes you can have great rates of return with low risk, depending on the circumstance, depending on the investment, especially if it's venture capital. So that's why we are believers, generally speaking, in people investing in alternative assets, or sometimes we'll call it hard assets, et cetera, et cetera. So for those reasons combined, sometimes it makes sense. What I would say is you got to think it through. You remember, you're your own financial advisor on situations like this because you're the trustee. We allow for unbundled at vastsolutionsgroup.com. We allow for unbundled investments. So one of the things you got to think about is, yes, sometimes this does make sense, although it can be risky at the same time. Here are the issues. Let's go over the downside. Got to be careful because you're your own advisor. In this case, especially because you're not going to have a financial advisor that you could, blame if things go south. It's up to you. Administratively, a lot more administrative risks you got to worry about because there's more paperwork. There's more, especially if it's in a defined benefit plan or cash balance plan. You got to make sure that everything is copacetic with your actuarials. So it's a lot more work and it's a lot more costly, which we're going to go over. Now, riskier. Why do I say risky? Because, we've had some clients who've invested a lot of money in alternative investments. And sometimes in a couple of cases too, I can think of right now that just happened last year, they lost all their money because it was in real estate in both cases. One in real estate, one in crypto. They lost all their money. So they ended up having, in that investment, writing it off to zero. So literally, one guy, smart CPA, actually brilliant CPA, he had $500,000 in a piece of real estate, or real estate project, I should say. and they lost it all. He literally lost it all, lost the whole down payment because the bank ended up taking it. It was a messed up deal. I don't know the circumstance, but I do know it was bad. And then the crypto deal, invest in a crypto deal that was thought to be, a perfect deal. And, they find out that it was a dump and pump or pump and dump, whatever you want to call it. Costlier, yeah, because the administrative issues, it's more expensive. Plus, it takes more of your time as the trustee. You're probably listening to this because you're in control of the plan, and you are going to be taking on a bigger burden. So it's a cost element, because now instead of, having a financial advisor potentially take care of it, it's you who's usually making a big amount of money. So it ends up being a little bit more costly. Okay, here's the caveat. I want to say that, we accept no risk at vastsolutionsgroup.com. You're the one who's in control of the investments. Sure, we will help you, especially at a cost. We'll help you make sure that all the logistics are taken care of. But, we accept no risk. We do have a division that actually can analyze deals, but more than anything, usually that's pretty rare that people have us come in to analyze deals. Sometimes they'll have us, have our CPA come in and analyze a deal for the on the books, but that's pretty rare. So again, usually it's you. We accept no risk. It's really up to you as to what happens. Now, what I would say is, I'm going to give a little summary again. My name is Kenneth French with vastsolutionsgroup.com. What I need to make sure that you understand, let's say you have assets in your defined benefit. Okay, defined benefit. You're the trustee. You're the one who's in control. And you see a piece of real estate as an example, or a private equity deal, a venture capital deal, or crypto. You can write a check or wire or what have you from the plan, from your company to wherever the investments will go, right? You're making it from your company as that being your contribution. Okay, that's number one. Then it's important, you're going to give them the plan documents for the defined benefit plan, because that's, in this case, that's going to hold the assets. Okay, paper goes to them. Now, the holder at the custodian or wherever we're talking about, all the assets in that case will be held, meaning what you've purchased, going to be held in the defined benefit plan. Okay, so the defined benefit plan, ABC defined benefit plan, will be the holder of that investment. In this case, alternative investment, piece of real estate, crypto, the list goes on. Okay, now, if income is pumped out of that investment, it goes back into the plan. Okay, again, it goes back into the plan, in the checking account or investment account, what have you. That's number one. Number two, it could go potentially back in that account wherever you have the alternative investment. Usually it doesn't. Usually it goes back into, in this case, I'm using an example of a defined benefit plan. It goes back to the defined benefit plan. It doesn't always have to. Those are usually the main two ways. Some people sometimes take via withdrawal, maybe an RMD, et cetera. It goes out to you as a participant, as an example. Rarely, but sometimes that's the case. So again, company asset wants to make a contribution in effect to the defined benefit plan. What they can do is invest in whatever the investment is we're talking about. That will be held, the asset will be held in the defined benefit plan's name. It will be signed as remember we talked about before, the trustee. The name, John Doe, TTEE, trustee. Income will go back to the plan, or when you sell the asset. Now let's talk about when you sell the asset. When you sell the asset, what happens? Let's say you put in $100,000 into whatever piece of real estate. It's now worth $1 million. Awesome, by the way. Then what happens is, if you sell that piece of property, it goes back into what? The defined benefit plan assets. Usually there's an investment account there. So the thing to think about is just, I give the analogy. Imagine I live in Seattle where it's rainy. Imagine walking under an umbrella, rain's hitting the umbrella. Seattle, it's always rainy, right? And all of a sudden you peek your head out of the umbrella, you're getting hit with rain, put your head back under the umbrella. In this example, rain equals taxes. So again, rain, taxes. Peek your head out, boom, the taxes are hitting you. Same thing with a qualified plan, with 401k, et cetera. When you take money out of the 401k plan, as an example, of defined benefit plan or whatever the case is, that's when you're taxed. Same thing with the qualified plan. One of the issues would be when people are investing alternative assets in, let's say, whatever piece of real estate, let's say defined benefit plan assets, if they take it out personally, that's when they're hitting taxes. So you got to think about that. You got to think about some logistics. In many cases, this totally makes sense to do alternative investments in qualified plans, but you just got to do it the right way. You need compliance. That's also partially what we do for bigger plans at vastsolutionsgroup.com. Now, there's kind of one more thing I need to talk about. Because it's an alternative investment, usually it's not as liquid. There are usually there's tests that need to be done. You can't hit certain threshold. What I would say is call into our office if you need some help. Talk to your actuary specifically if it's a defined benefit plan. If it's a profit sharing plan, make sure you're talking to your plan advisor. So these are some of the things to think about. I'm again going to say, I think it makes sense in a lot of cases for diversification, usually rates of return, to invest in, assets that are, traditional, that are not stocks, bonds, mutual funds. But you just got to be careful. Sometimes it can truly, as I mentioned with that CPA as an example, it could totally backfire. But in some cases, it's the way to go. So if you have any questions, go to our website, vastsolutionsgroup.com. We have more than enough resources there. We charge for services when it comes to this stuff. So be wary of that. Because again, I'm going to remind you, it's more costly to do these things. But what I would say is, hey, you just might end up diversifying, making more money, et cetera, et cetera. So I'm going to now close up shop, or we were talking about this topic. And again, that's alternative investments really within qualified plans. My name is Kenneth French. I really appreciate you spending the time watching and listening to this. And if it's been of any value, please forward it on to some people that are out there, because a lot of people don't know what I said at the outset. Financial advisors sometimes are wrong that you can put qualified plan assets, 401k, profit sharing plan, defined benefit plan, cash balance plan. You can put those assets in alternative investments to include private equity as an example, venture capital, real estate, private offering memorandums. Once again, Kenneth French, thank you for taking the time.